Welcome back to another episode of this option series. As mentioned in the previous episode, this next 2 months we're going to focus very much on options, specifically crypto DeFi options. And before we can go into understanding the various protocols available for options in the DeFi space, what we want to get started is to understand what options are and what volatility is. So last week, we talked about what volatility is. We talked about market volatility and we talked about implied volatility. This week, we want to understand how volatility plays a role with options, and then that's how we can go and move on to understanding options and the various strategies. So let's get started with understanding a bit more of options and bring options into the whole volatility topic. Once again, this is the DeFi option series, and we're going to continue this for the month of January and February. So, quick disclaimer, options are very complicated products. Everything is very risky. This is not investment advice, this is just educational. I want to explain what these different options are, what the different methods are, and what the different types of options there are out there. We'll cover 5 main things today. What are options? European versus American options. How to read options, because I've seen people asking that on Twitter. Option insurance as volatility hedge, which is one of the main things that I do want to share about, and DeFi versus TradFi options, or traditional finance options. So let's get started with options. We talked a lot about volatility, we talked a lot about understanding market volatility, implied volatility, but how does that affect you and me? Well, it affects us in the understanding of options. So what are options? The general idea is that options is really a bet to do something, okay, or an alternative to do something. So an option is really this. An option is an alternative, literally it means the option to buy or sell an asset at a specific price by a specific date. So if you have a paper and you sign on a paper, I will either buy or sell, you choose one of them, you choose one of the assets. So you have to choose 4 things. You want to buy or sell. So maybe I want to buy, and you choose assets. So you choose the Lisa tokens at a price. So a price will be 2 Bitcoins. And that's whatever the price will be by the 15th of January. So these are the 4 things you have in your options. There are a little bit more other stuff, which are the little variables that affect options. But this is the general idea of what the big option contract is. Because option is just really a contract and agreement to say that I will buy or sell this specific asset at this specific price by this date or on this date. So these are the things you agree on. And I don't have to buy it, I don't have to sell it. It's just that on this date, I could have the opportunity to buy or sell this asset at this specific price. And so it is good because it gives us some leeway, some strategies to play around with betting or to hedge against volatility or to use these kind of products as insurance. We're going to talk about them all later, but we're going to understand the basics first. So what is it like? So it's kind of like if when you're young and you marry, you make a promise with your best friend saying that, if you're both single by 40, we're going to get married to each other. So it's something like that. So you make a promise with each other, and when at that date, 40 years old or the option's expiry date, you can choose whether to execute the contract or not, or to execute the agreement or not. So by the time you're 40, you and your friend can say that, yes, we get married, or no, we don't get married. So that is really just an option. It's a promise to do something. You don't have to do it, but if both parties wants to do it, it will be done. And because of that, you have to pay for it, because this agreement is valuable, because if both parties agrees to it and say that, yes, we'll execute it, then there is value in that, right? So options are not free. Option contracts, you have to pay some money to it. So what kind of contracts or what kind of option contracts are there out there? They're generally just 2 types, a call and a put. So a call in general is to buy the option, and a put is to sell the option. So a call is where, let's say you want to buy Lisa tokens at 1 Bitcoin, and then I have a call option to that, so I want to buy it at this specific price. Then that is the agreement that we have. or you want to sell Lisa tokens at a specific price, that is the put option. So there are two types. In general, it really just, that's the thing, right? You either buy or you sell the option. Or it's either you buy or sell the asset. So these are the two option types available. So there are a lot of other things that we can go very in-depth into, with call options and put options. There are a lot of transactions going on behind that. But let's not go there first because it's going to be very complicated. We'll definitely talk about them next week and the weeks after. But just to keep you aware, or just to put at the back of your head, there are just two options, or two alternatives, or two types of options: a call option and a put option, which one is to buy the option and one is to sell the option. Now then, if you think about it, if the options are to buy or sell the asset, then what's the difference between me just holding the underlying asset instead? Why do I have to buy an option to buy or sell the asset when I can just hold the underlying asset? Well, it is quite simple. It is because two things. One is it gives you more varieties to play around with strategies. So if you are doing trading, if you're doing a lot of different complicated strategies, options might be a better alternative because it gives you more variety and more leeway to play around and strategize. The second thing also is that options, in the financial term, options are sometimes a much better alternative. So for example, if you are holding the underlying asset, then your losses can be unlimited because you could lose the entire underlying asset. Whereas if you're buying an option, the losses can be limited depending on what kind of options you're looking at. So in that financial aspect, options can be a bit safer. The other reason why you want to hold options you want to buy options versus holding the underlying asset is that with buying options, there's slightly less upfront amount of money to be paid. So let's say options cost $2 per option contract. And depending on the strategy you're looking at, then the maximum loss is that $2. And also the amount of money you're putting upfront is that $2 until you're willing to execute the contract. So in that sense, it could be friendlier in terms of the financial aspects. So there are a lot of benefits and pros and cons to holding the underlying asset versus buying options. You don't have to choose one or the other. You can mix them both together and you can play around with trading strategies. This is not a trading strategy channel, so that's not what I'm going to focus at. But there are a lot of other channels. Feel free to go and look at them. They teach a lot of different things. So let's go back a little bit more, take one step back to first understand what options are, because the different types of options, the different structures of options, the different ways to use options, they're going to be very important in the next couple of weeks where we're going to deep dive into the various DeFi options protocols. Okay? So one of the things that it's important to know first is the types of options. Okay, I know we talked about the option contracts available. You have the put and you have the call. Then another way of classifying options, you have the American option versus the European option. In general, they're in general similar, as in they're both a contract where an agreement where you can choose. You're not obliged to, but you can execute execute based on whatever is written on the contract. So in general, the execution is quite similar. The difference is that the European contract, you exercise only at expiry, versus the American contract you can exercise anytime. What do I mean? Remember the contract, the option contract that I mentioned? You can choose buy or sell, you can choose asset, you can choose the price, you can choose when it expires. Now we're talking about the when it expires part, the last thing. So if the European contract says that this options contract expires on the 15th of January, what does it mean? It means that you can only execute this agreement, you can only go into this agreement on 15th of January. You can't do it before, you can't do it after. On the other hand, the American contract, when it says 15th of January, you can execute on 15th of January or before 15th of January. So from now to 15th of January, you can execute it. And that is the American contract, the American options contract. The other difference is trade. So the European contract, it's usually OTC, over the counter. And this is because, as you can imagine, you can only execute it on expiration date. And this gives us very little leeway to use it, to play with it. And it's not so, it might not be so attractive to a lot of people. So there's not that much demand for it. And when there's not that much demand, you usually get it at OTC counters over the OTC counters or OTC trade. So it allows you to still have the market makers to be providing these options, but they are not as popular. The ones that's popular is the American kind of options, because they're traded more actively, because you can execute them anytime, and they're traded over the market. So you can just trade them, you can trade them in bigger markets where you have deeper liquidity. You don't have to just trade them over the counter, because OTC can have a slight premium usually in OTC markets, whereas traded over the market is a bit more efficient. It's a bit more efficient in price discovery. So what about the premium? As you can imagine, the European one is traded over the counter. The European one also has very stringent kind of rules set in place. What do I mean? It means that you can only execute it on the expiration date. So not many people are going to demand that. Not many people are interested to buy that, because it's not that attractive. If anything happens from now to before 15th of January, and there is something that could be very beneficial for my trade, I can execute it. So I can only execute it on 15th of January. And maybe that event is over by then, and the option contract is not that valuable anymore. So that is one of the problems. And so that's why it's slightly cheaper. So we call it the premium, the price of the option. It's the premium, slightly cheaper, versus the American option, because you can execute it anytime. It gives you so many alternatives to use it. So the premium is definitely higher. What about risk? As you can imagine, because the European contract is a bit more structured. You know when the expiry date is. You can estimate what the price is. You can also, the premium is also a bit lower. You can calculate the price. You can calculate the price and risk a lot easier with the European option, because most of the things are set in stone. Whereas the American option, it's a bit more difficult, because you have a higher risk. You can execute it anytime you want, and it's a bit difficult. It's a bit more pricey. It's a bit pricier to price this American type of options, or American type of option contracts. So this is just a difference in risk. And lastly, when talking about hedging, if you use European, I remember I told you that this episode is mainly about using options as volatility hedge. So with European contracts, it's a bit easier. European option contracts, it's a bit easier to use it to hedge, because it's easier to formulate. Because you know the price, you know when it's going to expire. By that time, you can choose to execute or not. And it's a lot easier to formulate your strategy. Whereas with the American one, it's a bit more difficult to formulate, because you could execute it today, you could execute it tomorrow, you could execute it the day of expiry. You don't really, there's so many alternatives. So it becomes a bit more difficult to strategize your hedging strategy. Whether it's good or bad, there's no such thing. It's really how you use it, how you execute it, how you find a way to use these strategies, use these tools available to get the kind of outcome, or to hedge against the kind of risk that you're looking to hedge. And now we go on to the third part of how to read options. I think reading options is quite important to understand what is going on. You might not be trading it, but it's also good to just have a general sense of what people's expectations of the market is. But without that, it's also good to just understand what is the table saying. So I want to give you a very quick understanding of what the table is saying. We're just looking at very simple options here, and that gives you some understanding, so that later when we go into talking a little bit more about options, you have some idea of what I'm referring to. So I took a snapshot of this for options that expire on the 15th of January 2021, so in the next 3 days. And I took a snapshot because prices keep changing, and I just wanted a snapshot right now. And at the point of time where I took the snapshot, Bitcoin is going at $36,000. And as you can see, there's 3 days to expiry for this options contract. Now, remember, there are two types of options contract. You have a call and a put option. So how do we read tables? We read the options table. Let's do it step by step. Step one is we look at the strike price. So that's the thing that cuts this entire table into two, the middle thing. It's like Moses parting the Red Sea. And in the strike price, you have the various values. These values correspond to the Bitcoin price. So all these option contracts are actual agreements when you go into a trade. And at these strike price will tell you the price that you go into the trade. As we talked about option contracts, you will talk about the buy or sell, the type of assets, which is Bitcoin, because we could also do Ethereum, but here we're just focusing on Bitcoin, so that's the asset. We can look at the price. So the price is the strike price that we see in the middle of the table, and the last one is the expiry date. So this expiry date, we are looking very specifically at the 15th of January, because that's a table that I've chosen. There are a lot of other option expiry dates. You can just go and take a look at that. Okay, so first thing first, we see the strike price, which is the thing in the middle. So what does it do? The thing in the middle splits the table into left and right. Second thing that we want to see is the calls versus puts. Calls is buying options, puts is selling options. Calls are usually almost always on the left. Puts are usually almost always on the right. So calls is selling, calls is buying, puts is selling. So how do we read that? Let's do a specific strike price, and then we look at what the calls is, what the put option is, what the call option is. So let's say we're quite close to 36,000, so let's look at $36,000. At $36,000 strike price, we can see that the bid and ask spread is quite okay. It's about $1,700 and $1,800. So this is the cost to buy this options contract. So this is the cost you put down to have the obligation to buy Bitcoin at $36,000 in 3 days' time. And if you think about it, that can be quite useful, because maybe Bitcoin is going to go up in the next few days. So maybe it's going to be 40,000 in the next few days, and you want to buy this today. You want to lock in your price today. So you lock in your price at $36,000. You pay maybe $1,700 for it, and 3 days later you spend, and then you go into the agreement agreeing that you will buy Bitcoin at $36,000 in 3 days' time on the 15th of January. And let's say by then the market is doing $40,000. So then you can take the Bitcoin, go into the market, sell it. So let's say you buy one contract, one Bitcoin for $1,700, and so that's your cost, right? $1,700. And then in 3 days' time, Bitcoin goes back to 40,000, and you purchased it at 36,000. So you buy it at 36,000, you go into the open market, sell it at 40,000, you make $4,000. $4,000. So $4,000, your profit minus your loss, which is your cost, your $17,000, you get $2,300. So that's your profit, and that is one way to use options in your trade, for example. So that is the call option, right? The buying. Now let's look at the other side and look at the sell option, the put options. So that's selling. Once again, we look at the same thing, $36,000, and the price to that contract is option contract is about $1,500 and about $1,600-ish dollars. So that means when, let's say, Bitcoin falls, so Bitcoin now is about 36,000. Let's say for some reason by 15th of January, Bitcoin falls to $30,000. Okay, so now $36,000, Bitcoin falls to $30,000 in the next 3 days. So what can this contract do? So let's say you purchased it at $1,500. So purchase it at $1,500 to be able to sell the Bitcoin at $36,000. So in 3 days' time, you have that Bitcoin, you sell it for $36,000, because someone, this contract is that someone will buy from you at $36,000, and then, but the open market is just $30,000, right? So you can go to your open market, purchase purchase one of them at $30,000, go to this guy, execute your contract, and get $36,000, and in that process you earn $6,000. You just have to less your bid, so your cost, which is $1,500, and you get $4,500. So that is in general how this very simple ways of using options in trade. And whether it's good or bad, as I mentioned in the first video last week, it's not really good or bad. It really is just how you use it, right? And this, I just want to give you some flavor of options, because then it makes sense in the next few stages. The most important thing that I want to talk about is options as insurance against volatility. So what do I mean by options as insurance? I talked about insurance in 2 different episodes. In fact, I talked about insurance in 3 different episodes. The first one is the economics of insurance. Insurance is a very opaque industry. It has a lot of money in there, and you have a lot of these people sitting on legacy technology when we have new technology like blockchain and DLT, trying to make it a bit more efficient, trying to make it more transparent. So there's a lot of money in insurance anyway. Then I talked about Nexus Mutual as the DeFi insurance. We spent a long time going deep diving into their Nexus Mutual contract, their token model, their policies. It's very, very interesting. So I'll just link it up. You can go and check it out in that video. So that is one type of options, one type of insurance. I also talked about the Bancor version 2.1 as an insurance. So they have insurance against impermanent loss. So the first insurance of Nexus Mutual is insurance against technological problems. So it could be bugs in the smart contract, it could be exploits in the smart contract. So that kind of internal technological risk. So we have Nexus Mutual. The second one is impermanent loss. When you're looking at liquidity provider, we're looking at decentralized exchanges, you could suffer from impermanent loss. And Bancor version 2.1 talks about insurance against this impermanent loss using their BNT token. So also did a deep dive into that, a lot of smaller easy bite chunks of videos to understand that as well. So those are really 2 insurance types of programs available in the DeFi space. The third one that I've been wanting to talk about for a long time now is options. How can we use options as an insurance against whatever that is coming in the space? And this insurance is quite different. First insurance of Nexus Mutual is technological risk. Second insurance in DeFi is Bancor, which is against a very specific kind of financial risk, which is the impermanent loss in DeFi. And the third one is options as an insurance. And this is something that you have in traditional finance anyway, in capital market anyway. So how can we take that and bring that flavor into DeFi? So we're looking at options. And before I go on to talk about this, there are a lot of different types of option strategies, option mechanisms. You have your bull spread, bear spread, you have your candle, you have your butterfly, you have your straddle. You have a lot of different kind of option mechanisms where you take a couple of option strategies, put them together, and then allow them to work with each other to reduce your risk and or increase your upside. So it really depends on how you use it. And I just want to show you one of them to give you an idea of how options can be an insurance. So one thing that we want to look at is put option. Remember what put option is? Put option is to sell the option. And how are we going to use put option? We're going to use it to hedge or to reduce our risk in our monetary risk or volatility risk in the DeFi space. So let's say it could be Bitcoin, it could be YFI, it could be any of these options available or all these digital assets available. Put option basically, number one, it helps to limit losses. And why does it limit loss? Because remember when we were talking about the options chart and I said that the Bitcoin, let's say it's Bitcoin, the strike price is whatever amount, let's say $3,600 for Bitcoin. And that means no matter how low Bitcoin prices go, let's say Bitcoin is going to be $30,000, but our agreement is that you will buy my Bitcoin or I will sell you my Bitcoin at $36,000 and you will buy it I don't care what the market says. I don't care if the market says that Bitcoin is worth $5,000. I don't care if the market says Bitcoin is worth $15,000. We have made an agreement, and you are going to buy my Bitcoin at $36,000. So in that way, it helps to limit the kind of, it helps to protect you against whatever that's going on in the market, because you get to lock in your sell price. And if Bitcoin, by the time that contract expires, Bitcoin is worth $40,000, then you just let the contract be. You just let the option be. You don't have to execute it, right? Because holding your Bitcoin and selling in the open market for $40,000 is a lot better than executing the contract at $36,000. So what it does, it's really helping you to limit your downside. So if Bitcoin prices fall very, very low, or if any of these assets prices fall very low, you know that this put option helps you to stop against the helps you to limit your loss, because you can always sell it at the price you agreed upon. So that's one of the insurance, because you get to hedge against this kind of risk, this kind of volatility risk, this kind of fluctuating risk. Of course, there are a lot of other types of mechanisms where you can hedge against volatility, where you can design very interesting strategies where prices can fall within a specific range and you make money, or fall within a specific range and you don't lose money. And that is how you can structure options into your trading, your investment, or your portfolio when you are trading. And these kind of simple options will be very important as we go deeper in the next few episodes of understanding how these DeFi options are being created and being used. But before we go into that, I hope this will be the last time I'm going to talk about traditional finance and options, because I want to compare them together. And the focus will really be DeFi options. So let's look at traditional finance versus DeFi in terms of options. With options, as you can imagine, you have liquidity providers, you have buyers, you have sellers. So liquidity providers is like your market makers. You have them in all these big financial markets, right? You have people who are actively buying and selling when retail people, or like people like you and me, want to buy and sell. And then you have buyers and sellers. So these are buyers and sellers are people like you and me. Liquidity providers or market makers, they have to fulfill the trade. So in general, that's how traditional finance works. It works in stocks, it works in equity, it works in options. Because the options contract, you have to buy from someone, right? And you buy them from the liquidity providers. In DeFi, you have something similar. You also have liquidity providers, you have buyers, you have sellers, and you have a protocol. So the protocol is really the machine or the technology to execute all these different buying and selling. Liquidity providers might also not be one big individual market maker saying that I'm going to provide liquidity. It could also be a lot of individual decentralized market makers or autonomous market makers coming in together to become liquidity providers as a whole, and then to be providing all these option contracts to buyers and sellers. So people like you and me, where we want to use options to hedge against volatility or price movements in the market. The protocol is really the machine to help execute all of this. The protocol could also be the system issuing tokens, executing smart contracts, running smart contracts. It depends on how the protocol is being used. It's just bear in mind that in DeFi, for DeFi options, you have a fourth party, which is the protocol. So what can the protocol do? The protocol can incentivize buyers and sellers to purchase. The protocol can also help option sellers to get premiums, because that's the main thing that incentivizes people to be selling options. They can make money, which is the premium. The premium is the price you pay for the option. And then the protocol will also be minting or managing tokens. And these tokens can help to align the incentives between all the three parties: the liquidity provider, or the market maker, the buyers, and the sellers. So that's why the protocol is important in this aspect. So what needs to be done? When we look at options, we are looking at three stages. Firstly, before the option exists, so the creating part, the market creation, the option issuance. So before the option contract exists, then what needs to be done? The second thing is, when the option exists, how is it being done? Remember we talked about European versus American options? This is something to consider. Will the option be executed anytime, or can the option only be executed at expiry? And lastly, it's settlement. So you can see it's 3 different stages: before the option exists, when the option exists, and when the option expires. And number 2, when option exists, even if it's a European option that settles only on the expiry date, you can still take this option and trade it, right? I could purchase, or I could create the option contract, and then it expires on 15th of January, tomorrow is the 13th of January, and I realize, I don't want this contract anymore, let's put it in a market, see who wants to buy. So that's absolutely possible. And the protocol can do that. The last one is settlement. When it expires, or when people want to settle the options, how is it done? How is it executed? And to what extent are we using smart contracts? So these are the 3 different stages to consider. What is the trouble? Now, the trouble comes in 2 big forms. The first one is collateralization. That is because, so there are 2 troubles to talk about. The first one is collateralization, because you have to give collaterals to create these options, right? Especially when we're talking about crypto assets, it's a bit more complicated, it's a bit more difficult. It also depends on what kind of settlement. Would it be cash settlement, or would it be physically delivered? And how do you look at collateralization? How do you define how much to collateralize? What is being accepted as collaterals? And all these kind of aspects. So that's something to consider. And the other thing to consider is also, how will the protocol reflect the change in the premiums dynamically? So there are a lot of ways to be pricing options. The most famous one is the Black-Scholes model, or Black-Scholes formula, and it's a bit of a complicated formula to be pricing options. It's not perfect. There are a lot of things that can be improved, but gives us a general way to put our assumptions of options into a pricing number, onto a number. And that's something that we're comfortable with. So how can the protocol reflect different changes? It could be implied volatility, it could be the delta, it could be the rho, it could be the skewness. How do you take in all these different information when creating these kind of options? Because the other thing to also think about is, do we want them standardized options, or do we want options to be a bit more customized, where it becomes a bit difficult to standardize, and then it becomes a bit more difficult to trade? So there are a lot of things to think about. There are a lot of issues to consider, to ponder upon, and figure out how to use tokens to solve them, or just other ways to solve them beyond just the very traditional way that we are very used to in the capital market. So things that could change, that will affect the protocol, or that will affect the option contract, is changes in option pricing, changes in the underlying asset, so the change in Bitcoin prices, the change in, whatever other asset prices, the time to maturity, because as it becomes closer and closer to expiry date, the price actually falls because the contract is less valuable as it nears to the expiry date. Or volatility, which is, we talked about volatility last week, implied volatility. Usually the higher the volatility, the higher the price of the option. The interest rates and the dividends. We don't really have dividends. We don't really have that much dividends in crypto, because there's a whole nother video to talk about, but that's something that we don't consider so much of right now. So lastly, these are a lot of big questions that we're going to answer them slowly, one by one, in the next few videos. More importantly is, why do people buy options? And I think that's something I do want to conclude with, because we talk about how options can be very complicated. We talk about options being, there are a lot of charts to look at. There's candle charts. There's you have different kind of bid-ask spread. You have so many things to consider when using options in your strategy. And so why do people do that when it's so complicated? The thing is, it's actually not that complicated. It really depends. If you know exactly what you want, let's say I'm just using options as a way to hedge against volatility, or as a way to reduce my risk, then it's a lot quicker to get to where you want to go and use options in your strategy. So, and that is one of the reasons why people buy options, because it can be an insurance against price dropping. If price drops too low, then I'm going to lose out because my asset is not as valuable. But if I have a put option that says that someone will definitely buy from this option from me at this specific price, then there is a hedge, right? A hedge against the market movement and volatility. So it becomes a monetary hedge, monetary insurance that it's comfortable because I can limit my loss. So that's one reason. The other reason is to bet about the market. As you can imagine, options can be quite complicated, so you can use it very intelligently to bet about the market. If the market is going up, if it's bull market, then maybe you can do some form of strategy, which I'm not going to share too much because I'm not an expert in that. There are a lot of better people who are experts out there, and I don't want to be providing financial advice. Just know that options have a lot of weight. You can strategize options in many different ways, which can be really, really fun, and you can gamble intelligently about the market. I use intelligently because Reddit has proven me otherwise about what intelligent is. But just know that it can be quite fun. It can be quite interesting to go and explore of how to use options to be an insurance, or using options as a way to be limiting your loss but having quite high upsides. So that's it for today. I hope it gives you some understanding of what options are and give you some clarity so that when we go on later to the different ways to compare against DeFi option protocols or different ways of tokenizing options, it gives you more clarity of to know what we're discussing about and what we're talking about. Till then, the Token Economics Premium Access is available at bit.ly/econsdesign, or you can get our new release book of Economics and Math of DeFi and Token Engineering at book.economicsdesign.com. Till then, I'll see you next week. Bye!